Jobs numbers came in stronger than expected today on Friday as the non-farm payrolls grew at 531,000, which was more than the consensus estimate of 450,000. The unemployment rate subsequently went down to 4.6%, down from 4.8% in September. The consensus estimate for this month was 4.7%. We're here to discuss strengths in the labor market and what this could mean for the financial markets with Jim Awad, the Senior Managing Director of Clearstead Advisors. Jim, welcome to Kitco. It's a pleasure to have you today.
Thank you. My pleasure.
So as I've stated earlier, the employment outlook seems to be picking up. Jobs numbers are picking up, and the unemployment rate is falling. Is this in line with your expectations, Jim?
Yes, it's a very strong number. The economy is reaccelerating in the fourth quarter. There's tremendous demand for workers. There's tremendous demand in the economy. Workers are being hired, and there still is some longer-term issues about the participation rate, which has been sticky at a low number. But net, it was a strong number. Wages were up. Previous numbers were revised upward. It speaks to the strength in the economy, and the stock market is celebrating it as we speak.
Okay. The unemployment rate falling, how much of that is due to an actual reacceleration of the economy versus just some of the temporary workers coming back into the market? Because as you recall, Jim, third quarter GDP was rather weak compared to the previous quarter.
Yeah, well, the fourth quarter is reaccelerating. So I think what you'll see is anybody who came back temporary will be inclined to stay full-time, and you'll see the unemployment rate continue to decline and hourly wages continue to grow as we celebrate what should be a very strong fourth quarter. If you talk to all of the companies, Expedia, the hotel companies, they're saying Simon Properties, they're saying that people have a lot of money. They've been cooped up for a long period of time. They are anxious to get out and spend and do things. And of course, this morning we have the news on the Pfizer COVID pill, which is really a game changer in terms of the pandemic. And as that gets rolled out, you're going to reduce people's fears of going out and circulating. And the economy really should be able to operate at maximum capacity over the next several months.
This is an interesting report. I'm just going to read a few paragraphs from my colleague Anna Golubova over here at Kitco News. She said, more Americans are quitting their jobs as they cite financial freedom gained from their crypto investments, according to a recent survey. Civic Science poll showed that 4% of 6,471 respondents resigned from their jobs in the past 12 months, citing financial freedom due to their crypto investments. So as you know, of course, the quits rate has also been going up, actually higher than ever. And so this is an interesting phenomenon. You got people returning to the workforce, but also people voluntarily leaving the workforce for a variety of reasons. One of the reasons I just stated, they're making a lot more money from crypto investments than their regular jobs. What do you make of that?
Well, I think this is what you should expect in an improving economy and in an era of rising financial assets. People have money. This will continue as long as the economy and the financial markets continue to cooperate. The way it will end, if you look at history, is at some point the inflation numbers will accelerate to a degree that the Fed will start to raise interest rates. And that will be a pressure on financial assets of all kinds, including stocks, bonds, and crypto. And that will be the test for the economy. But right now, all the engines are on ignition. And it does not surprise me that people are making money and don't want to get back to work. But as wages rise, that will draw more people back into the workforce.
One more question on the labor market, Jim, and we'll move on. Have you observed difficulties in hiring where you're living? So, as you know, in the summertime, there was a shortage of labor and it was difficult to fill jobs. Is that still happening?
Yes, there are signs everywhere. We're hiring. There is a shortage of workers in every aspect of the economy. And the way that gets solved is through further growth, further wages to induce people to come back to work, and also receding fears of getting sick from COVID will induce people to come back to work.
All right, so let's talk about inflation. You brought that up. Key point here, rising wages is down the line. What is that going to do to the inflation rate?
Well, rising wages are an accelerant of inflation. And the fear here is that just look at the deer strike. They were offered a very generous compensation package, and they said they want more. So if people, it sort of becomes a circle. If workers are feeling inflation and paying more, then the nominal wage gains might not be real wage gains, and they may demand even more rises in wages. So the risk is that the expectation for inflation becomes self-fulfilling as it did in the 70s. At this point, it doesn't look like it's going to be that bad, but you are going to get higher wages, higher inflation, higher interest rates over the next 12 months.
Do you think we'll have stagflation? It's something I've heard from several economists I've spoken to.
No, I think the growth is real. The pent-up demand is real. It'll be higher growth with higher inflation and higher interest rates. And as Jamie Dimon and Brian Moynihan of J.P. Morgan and Bank of America both said, to an extent, the markets can handle that. Higher interest rates, higher inflation are manageable up to a level, but they get to a level where it forces the Fed's hands, and that is the threat to the financial markets over the long term. I don't think it's an issue for the next 6 months, but it might be an issue beyond that. Of course, there are some long-term disinflationary forces. The Cathie Wood argument about technology and the Amazons of the world putting long-term pressure on inflation, and also as the supply chain shortages get alleviated, that should weigh against inflation. So this is something we're going to have to watch over the next 12 months. For the moment, inflation and interest rates look like they're headed higher, not to a danger zone, but they must be watched because that is the Achilles heel of the good economy and the good financial markets that we're experiencing.
Yes, and there's a school of thought, Jim, that the Fed cannot raise the Fed funds rate because they'd be stuck. They would be overburdening the Treasury with really extraordinary amounts of interest expenses. Think about $30 trillion of debt that we have.
Right.
At just 5%, that implies $1.5 trillion of interest expenses, which is, about half the nation's gross revenue from taxes. So what do you think?
That's the long-term risk to the economy, and it's been there for a while. And we've had a free pass here with low inflation and low interest rates, but the market will take rates higher and force the Fed's hand if we get to that point. And the Fed will have no choice but to catch up. And as a nation, we'll pay the price. And that's out there, but that is not a 12 or 24-month problem. But I'll tell you, if we get into that scenario, that will be the end of the bull market, and interest rates will it'll be the end of the economic expansion. So that's what we have to watch. But I don't think it's something over the next 12, 18 months that's going to be a threat. But we do have to watch it.
Investment implications then. So over the next, let's say 12 to 18 months, let's narrow the time horizon down first. What do you think should be the ideal asset classes that investors should pay attention to?
Well, it's a risk-on environment. So you want to own equities first and foremost, and a wide variety of equities. You can own both growth stocks and opening up stocks because the whole economy will benefit. You do not want to own long-term bonds because as inflation and interest rates go up, they will go down in value. Real estate should do well in that environment. Anything that benefits from inflation, alternative investments should do very well. Private credit, alternative investments of every kind. And I won't comment on crypto because it's anybody's guess and the jury is still out. But for now, crypto has a tailwind. The test of crypto will be if you get into a risk-off environment with higher interest rates. That will be the test as to whether crypto is just a speculative fad or a hedge against inflation.
Any particular sectors in the stock markets that you favor right now, Jim?
Well, long term, I'm still a believer in the moderate growth technology stocks, the Apples and the Microsofts of the world. But you have to say that the reopening stocks are going to do well over the next several months. Also, the one thing I would say to people is this is a bull market, but it will end. And so don't downgrade in terms of quality. And I would tell people playing the meme stocks, be careful. Someday it's going to go against you.
Yeah, well, some people have been burned by that already, Jim. It's not a matter of when; it's a matter of how. Now, Jim, what about valuation? Some investors argue, well, maybe I haven't gotten in before. Maybe it's too late to get in now, given how much the stock markets have already run up in the past year. Is it too late, Jim?
No, I think you have a 12-month window here where you can make good money, especially relative to cash and bonds. With profits growing and the economy growing and interest rates, while they'll be rising, they will not be at a danger level for the next 12 months. So I think we have a 12-month fairway here, but there are longer-term risks, but not for the next 12 months.
Let me just posit this crazy theory for you, Jim, and feel free to disagree with me. So there's this notion now that valuations don't really matter anymore. Because if you look at what was driving the meme stocks, for example, it was just social media chatter. A bunch of people online came together and decided to herd into one specific market. They didn't care about valuations or, fundamentals. Most of them didn't even know what the companies did. And so one would argue that today, in today's environment, all you have to do is follow the herd, go on social media, and follow the momentum. Would you agree or disagree with that sentiment?
No, I would caution you not to play that game. It's not sustainable in the long term. And what will change it is if you morph into a risk-off preservation of capital environment, that game will disappear very quickly. And I can understand that people are making money on it and it's fun, but whenever it gets that easy, it's a bad ending. With 52 years experience in the business, in the strongest way that I can, I would say don't play that game.
I understand. Finally, how do you feel about the risk-off assets, treasuries, municipals, gold, precious metals?
Well, treasuries and any sort of debt instrument over the next 12 months is not going to have a positive return. Gold sometimes has done well during periods of inflation, sometimes has not. And time will tell whether it's going to what it's going to do this time. But I would say for the next 12 months, your risk on is going to do better than your risk off. If you want to hedge a little bit with gold and crypto, that's okay. But I think the better hedge are alternative investments, private credit, equity funds are a good way to hedge against the long equity exposure.
Mm-hmm. Final point, and I'll let you go, Jim. Because the jobs numbers came in stronger than expected, would you not argue, or could one not argue, that it's possible now that the Federal Reserve could lift off before or sooner than expected, thus presenting a bearish case for stocks?
Well, the market can handle 3 or so interest rate increases before it gets necessary. The expectations in the market are that the Fed will start in June and they will raise 2 or 3 times by the end of next year. So I would say 2023 is when you can become concerned, but there's still runway for 2022.
Excellent. Jim, thank you so much for coming on the show today. It was a pleasure to meet you, and I hope to speak to you again soon. Thank you.
Thank you. My pleasure.
And thank you for watching Kitco News. I'm David Lin.